All right, so the next step of the accounting cycle is posting journal entries. So in chapter 3, we started off with recording journal entries. Now we're going to be posting those journal entries to the ledger. And what we're going to be discussing is T accounts. Now each account has something called a T account. Now remember, most organizations use some form of accounting software to keep track of their accounting, but in order to understand accounting, you need to understand what a T account is. All right, so a T account is, say we're talking about our cash account. So we have a cash account. A T account shows both a debit and a credit. Now remember, debit is always on the left and credit's always on the right. So we have debits, credits, and on the debit side we have assets, draw, and expense. All right, so in their positive form, assets, draw, and expenses will always be debits. Now on the credit side, we have liabilities, owner's equity or capital, equity, and we have our revenue. So we have liabilities, equity, and revenue. In their positive form, they will always be credits, and they'll be on the right side. All right, so let's take our class example. Anne, with greater athletic performance, she invested $35,000 to start her facility, her sporting facility, to train athletes. So she invested $35,000. So the two accounts being impacted are cash and equity. So if we look at our cash account, our T account, we're going to have a debit of $35,000. And in our equity accounts, we have Anne's capital. So we have a T account for Anne's capital. We have a credit of $35,000. Now remember, there always has to be a debit and a credit in order to keep the basic accounting equation in balance. So we have a debit and we have a credit. She invested $35,000 cash, and she lays claim to that $35,000, so it's Anne's capital account being impacted there. All right? So now, I'm not following exactly the story, but say Anne buys equipment. Okay, she buys equipment and furniture for $20,000. She pays cash. So we have two accounts being impacted. We have the cash account and we have our equipment and furniture account being impacted, right? So let me erase this real quick and put these up here. So we have our cash account, our T account. She invested $35,000 cash. Now she purchases equipment. So she has equipment. And then we have our Anne's capital down here that was already impacted. And we have $35,000 as our credit. All right, so let's just say she purchases $20,000 worth of equipment. Like I said before, she needs equipment for her facility to train the athletes. All right, so she purchases $20,000 worth of equipment and she pays cash. So cash in its negative form is a credit, because in its positive form it will always be a debit. So the cash is leaving the company, so you have to put a credit in the T account of $20,000. So 20,000 on the credit side. But we're gaining $20,000 worth of equipment. So we have 20,000 as a debit in your equipment account, all right? So if we were to total these accounts up, you would take the 20,000 in the cash account and subtract it from the 35,000 to get $15,000 cash. So Ann's got $15,000 cash in her cash account. So that's how the T accounts work, and we're going to go through all of the steps in the story. We're going to go through all of them. So I'm going to erase this, and then I'm going to put up all of the T accounts from the story. All right, so if we're looking back at our journal entries from the story, the class story, Ann invested $35,000, right? So we had $35,000 on the debit side, $35,000 cash, and Ann's capital account is impacted by that, and that would be a credit because equity, here, let's put this up here. Equity in its positive form is always a credit, right? So we have a credit on Ann's capital, and we have a debit on cash because cash is an asset, and in its positive form is a debit, right? All right, so we had that. Then Ann purchased equipment, right? So we had equipment, which is an asset, so it's a debit of $20,000, and cash of $20,000 going out, right? So that's a credit. So the two accounts impacted there are cash and equipment. And our debit is our equipment, and our credit is the cash going out. Now, Ann decided to purchase supplies and furniture. So she paid $1,500 on account for supplies and furniture. So she didn't pay cash, she put it on account. She owes that money, right? So our accounts payable, I have everything abbreviated here. So AP is accounts payable, AR is accounts receivable, and then I have expense as EXP and revenue as REV abbreviated here. So Ann will owe that $1,500, right? So it's a liability, and if we look up here, liabilities are credits. All right, so we have supplies and furniture purchase. So those are our assets, so that will be our debit. So we have $500 worth of supplies and $1,000 worth of furniture, right? And we owe $1,500 for those supplies and furniture, all right? Ann owes that $1,500 for the furniture. All right, let's look at our next journal entry. And Ann received revenue. She received $850 in cash for services she provided to her athletes. Right, service revenue. If we look up here, service revenue, revenue is always a credit. So we have revenue in its positive form, which is a credit. So we have $850 going in the service revenue account. And our debit is our cash, and that's $850 cash in our cash account. So that's our debit. So we have our debit and we have our credit. Now let's look at the next entry. So we have Ann pays off the accounts payable account. So she pays $1,500 cash to pay off accounts payable. Right, so our credit is our cash going out, and our debit is paying off the accounts payable. All right, so we have a debit of $1,500 because we no longer owe that to our customers. So when we go through this account, we see that it zeroes out. We no longer owe that, right? So our debit is the $1,500, and our credit is the cash going out of $1,500. So Ann no longer owes for the supplies and furniture she purchased on account. Accounts payable is paid off. All right, so that's paid off. Our next journal entry is we provide service for someone for $2,500. So Ann provides service. She gives lessons, or she holds a camp, and say a baseball camp, and she earns $2,500, but they pay her on account. So they didn't actually pay her cash, so they owe her $2,500. All right, but she already provided the service, so we're going to put service revenue of $2,500. Right? So she provided the service, but she still owed the $2,500 because they put it on account. All right? Our next journal entry is advertising expense. So Ann would like to advertise her organization. So if we look up here, expenses are always our debit, right? So we have expense, advertising expense, and she pays $250 for advertising expense. She pays cash, right? So we have $250 going out of the cash account. So we have a debit and we have a credit. Always have to have the debit and the credit. You always have to have two transactions, at least two transactions. All right? Next, Ann receives $300 cash for the accounts receivable. So she receives $300 of what she's owed for accounts receivable. Now she had already recorded the $2,500 in service revenue. So the two accounts that are going to be impacted are cash, because cash is coming in. So we see $300 on the debit side of the cash account because we were paid that $300. And we see a credit on the accounts receivable account of $300 because that $300 is no longer owed. So when we tally this up, we know that they only owe us $2,200, not $2,500. All right? So that's that transaction. Now let's look at the next transaction. Ann pays rent expense. So we have rent expense down here, and she pays $1,700. Now in the positive form, expenses are always a debit. So we have $1,700 paid in rent expense, and she paid cash. So we have $1,700 going out of the cash account. So we have our debit and we have our credit. All right? All right, the next one. Ann decides she wants to withdraw $400 from the company for her own personal use. Right? So we have Ann's drawing here. And if we look up here, drawing is always a debit in its positive form. So we have $400, in Ann's drawing. We have $400 cash going out of the organization. All right? All right, so now if we go through and we add up the numbers in the accounts, so if we take all the debits from this side, 35,000, 850, and 300, add those together, and then subtract the credits from the debits, the 20,000, the 1,500, the 250, the 1,700, and the 400, we get a total of $12,300 in our cash account. Now, it stays as a debit because our debits exceed our credits. Now, if our credits exceed our debits, that means you would place it on the credit side, and that would mean that our cash is in negative, right? So we have $12,300 in our cash account. Then we see we got $2,500 in our accounts receivable, and then we have a credit of $300. So we subtract that $300 from the $2,500 to get $2,200 in our accounts receivable account. Then we have $500 worth of supplies, $1,000 worth of furniture, $20,000 worth of equipment. And when we add all our assets up, when we add our $12,300 cash, our $2,200 in accounts receivable, our $500 in supplies, our $1,000 in furniture, and our $20,000 in equipment, we get a total of $36,000 worth of assets. So we have $36,000 worth of assets. Now our accounts payable account is zeroed out because we are no longer owed that $1,500 because it was paid off. So it's zero. Ann's capital account is $35,000. Ann's drawing account is $400 because she withdrew that money from the organization. Our service revenue account is at $3,350. Our advertising expense is $250. Our rent expense is $1,700. So when we add all these up, we have zero, we have $35,000. Now, Ann's drawing reduces owner's equity, so we subtract the $400 from the $35,000. We add the $3,350 of revenue. We subtract the advertising expense of $250, and we subtract the rent expense of $1,700. And we get a total of $36,000. So our assets equal our liabilities plus our owner's equity. So these are T accounts, and they keep the basic accounting equation in balance. And when you add these together, they should equal out. All right, so this is the T account. Remember, with T accounts, you always have to have a debit and a credit. Always a debit and a credit. Our debits in their positive form would be assets, drawing or withdrawal, and expenses. Our credits in their positive form are liabilities, equity, and revenue. Right? So that's our T accounts. All right, so with T accounts, you have the general ledger, and the accounts receivable account in the general ledger. So that's where all the T accounts are. The accounts receivable account tallies up the accounts receivable from various companies. So if we're Ann's company, so Greater Athletic Performance, if we're Greater Athletic Performance, and we know that Sports Company owes us $2,000, and we know that Athletic Wear owes us $500. So they purchase things on account, these two companies. We would have these subsidiary accounts for the individual companies, right? So we have a subsidiary account for sports company, accounts receivable, and we have a subsidiary account for athletic wear, accounts receivable. But then we take this information and we put it to the control account, so that's the overall accounts receivable account that's in the general ledger. So we have $2,000, and we have $500 that we are owed on accounts receivable. So then we find out that sports company pays us let's say $200, all right? So they pay us $200. So that's removed from that account there. So we are only owed $1,800. So we would have to add this $200 to the control account in the general ledger. And let's say that athletic wear pays $300. So we are no longer owed that $300. So athletic wear accounts receivable is moved down to $200. So we add that $300 to the controlled account, all right? So we have $2,000 in accounts receivable. We're still owed that $2,000. So the subsidiary accounts are T accounts for individual companies who owe us on account. And the same goes for accounts payable. There's subsidiary accounts for each individual account that we would owe. So if we put things on account, we would have subsidiary accounts for each company that we owe. So those are the subsidiary accounts, and this would be the control account. And the same would be for the accounts payable. We would have a control account for accounts payable. So those are the subsidiary ledgers. And that's the end of chapter 3. So we learned about journal entries and posting those journal entries to the general ledger or our T accounts. And our T accounts always have debits and credits. So we have debits on the left side and credits on the right. When a transaction happens, there always has to be a debit and a credit in order to keep the basic accounting equation in balance.